sale of business property. This is a complex subject that I have been teaching since 2001, and I first wrote parts of this course for a basic tax course that I started teaching back in 2001, and at the time I created a problem for a character named Diana Prince. She is the homework assignment for today's class. If you're a webcast or a webinar student, you don't need to prepare the assignment, but if you are a self-paced student, you are required to. And I've had a number of people over the years tell me that they hate me for Diana Prince, that she's the worst assignment they've ever been given. But really, today's class, by the time you're finished it, I'm going to have provided you with the tools necessary to prepare her return correctly. Of course, you need to understand depreciation and other tax concepts before you move on to prepare an assignment like we have with Diana Prince. But at the end of the class, hopefully you will understand the basics of Form 4797, how to complete it, and for the most part to be able to prepare Diana Prince's return. I have another assignment that will be a classwork assignment for today. It contains some elements of what we see in Diana Prince, but on a simpler level, so you'll be able to work your way up to her. So let's begin at the top of what is now page 4 of the manual with the sale of business property. And I'm going to be communicating some terms to you. And I don't really like to talk in code. I don't read the code unless I absolutely have to. It's just not my thing. I prepare tax returns, and it is totally permissible in terms of preparer competence, ethics, due diligence to reference IRS publications and instructions for tax forms. It's not necessary to read the code. There are certainly people out there who read the code, specialize in the code, and if you're around IRS auditors, they speak codese, as I call it. You mention something to them, and they'll go, well, what section code is that in? I need to go look it up. If I don't know what section code it is, I don't know how to look it up. And I'll go, but it's in pub whatever, and they'll go, but they talk section code. And in some respects, section code is used throughout the IRS publications, and tax software often refers to section codes as well. If you want to make a section code election, check this box. You'll see that in tax software, and then you'll go, I wonder what that's about. What happens if I check the box? I don't know. Just check the box and see what happens. So the safe solution would be to really just go look up what the meaning of that section code is and not just randomly check a box because it's there. But there are certain section codes where the computer software is assuming a certain level of competence from the tax preparer, and that you should know what it means when it asks for you to enter Section 1250 gain property or Section 1245 property. It expects you would know what those types of properties are. So by the time we're finished with today's class, you will know what they are. At least you'd better know what they are if you're paying attention. Now, when you dispose of business property, your taxable gain or loss is usually a Section 1231 gain or loss, and the treatment of gains or losses as ordinary or capital is determined under the rules for Section 1231 transactions. When you dispose of depreciable property at a gain, you may have to recognize all or part of the gain as ordinary income under the Depreciation Recapture rules. Then any remaining gain is a Section 1231 gain. Sales of business use assets are not directly reported on Schedule D or Form 8949. Instead, the sale of business use assets is reported on Form 4797. So let's talk now about Section 1231 property. What is that? Well, property that is held and used in a business for more than a year is generally considered to be Section 1231 property. The sale of a Section 1231 business asset is generally considered to be the sale of a capital asset, and the net gain or loss from the sale is treated as long-term capital gain or loss. And the following assets are Section 1231 assets. Section 1245 property, which is any property that is or has been subject to an allowance for depreciation or amortization, as well as Section 1250 property, which is real property. Moving on to Section 1231 gains and losses. Section 1231 gains and losses are the taxable gains and losses from Section 1231 transactions. How you treat the sale depends on whether you have a gain or a loss. And that Section 1231 loss is an ordinary loss reported on 1040, line 14. And a net Section 1231 gain is ordinary income up to the amount of prior year non-recaptured losses and is reported on Form 1040, line 14. The rest, if any, is long-term capital gain reported on Form 1040, line 13. Got it? So, non-recaptured Section 1231 losses. Your non-recaptured Section 1231 losses are your net Section 1231 losses from the previous 5 years that have not been applied against a net Section 1231 gain. Therefore, if in any of your 5 preceding years you had a Section 1231 loss, a net gain for the current year from the sale of Section 1231 assets is ordinary income to the extent of your prior year losses. These losses are applied against your net Section 1231 gain, beginning with the earliest loss in the 5-year period. Now, it happens to be that this little sentence here on non-recaptured Section 1231 losses occupies a space in tax software where often it will have this worksheet there showing you what your non-recaptured Section 1231 losses are and what year those losses are applicable to. And you might be scratching your head going, why is my computer software generating this worksheet? What does that mean? And then we move over to the IRS-C exam where they actually do throw a question at you on this very topic. So I thought that although we're just starting off on this class, I would throw this C exam question at you because I think it does a good job covering this particular rule right here. So I'll just center it on the screen underneath the heading for non-recaptured Section 1231 losses. So when you read this sentence or these paragraphs on what a non-recaptured Section 1231 loss is, and then you're thinking of what your Section 1231 gain is, try and answer this question, which reads, unrecaptured Section 1231 gain. John sold the following assets in 2014. A printing press with a sales price of $25,000 and an original cost of $20,000. Also allowed or allowable depreciation on it was $8,000. He also sold computer equipment with a sales price of $30,000, an original cost of $28,000, and allowed or allowable depreciation was $14,000. John had net Section 1231 loss of $6,000 in 2013, and what is the amount and character of his gain for 2014? So I'll just give you about 5 minutes to think on this, and then we're going to go over the answer. The correct answer is C, and I think it's the one answer no one checked. Yeah, so no one selected the correct answer. Interesting. So this is a complicated topic, and I know that by reading the paragraph myself, I can be left confused. But this particular C exam question brings it all to clarity if you actually read the instructions that appear in IRS publications and then compare them to the problem itself. So what I've done is I've created a paragraphical description, and we'll just go through it together. Firstly, the reference for this particular question can be found on page 28 of IRS publication 544 that has to do with non-recaptured Section 1231 losses. And it says that your non-recaptured Section 1231 losses are your net Section 1231 losses for the previous 5 years that have not been applied against a net Section 1231 gain. Therefore, if in any one of your 5 preceding years you had a Section 1231 loss, a net gain for the current year from the sale of Section 1231 assets is ordinary gain to the extent of your prior year losses. These losses are applied against your net Section 1231 gain beginning with the earliest loss in the 5-year period. To determine the treatment of the Section 1231 gain and loss, combine all of your Section 1231 gains and losses for the year. If you have a net Section 1231 loss, it is ordinary loss. If you have a net Section 1231 gain, it is ordinary income up to the amount of your non-recaptured Section 1231 losses from previous years, and the rest, if any, is long-term capital gain. So let's take this question and break it down into its component parts. We can see that he had a printing press with a sales price of $25,000 and a cost of $20,000. If we take 20 from 25, that means we have a $5,000 capital gain. But we also have $8,000 of depreciation, and when we're finished talking about today's class, we're going to learn that that depreciation gets recaptured as ordinary income. So $8,000 of depreciation is going to become ordinary income, and we're sitting there right now with $5,000 that qualifies for capital gain income. We then have computer equipment that has a sales price of $30,000 and a cost of $28,000. That leaves a $2,000 capital gain, but we also had $14,000 of depreciation recapture. And depreciation recapture, again, is taxed as ordinary income. So if we look at what we have for capital gain income, we have $5,000 plus $2,000, or $7,000 of capital gain income. And we have ordinary gains of $22,000, or $8,000 plus $14,000. However, that $6,000 of prior year unrecaptured loss is going to turn some of our capital gain income into ordinary income, to the extent that we have a prior year unrecaptured loss in the last 5 years. And within the last 5 years, in fact, only 1 year ago, we had a $6,000 Section 1231 loss. And the deal with that Section 1231 loss is it was treated as an ordinary loss, and it could offset all other ordinary income on the return in full. And now we're turning around a year later and realizing Section 1231 gains and wanting also to get this capital gain treatment only 1 year later. So IRS says, sorry, you can't get away with that. We're going to take $6,000 of the $7,000 of capital gain and turn that into ordinary income. And therefore, the capital gain is going to be reduced to $1,000, and the ordinary gain is going to be increased to $28,000, which is why C is the correct answer. So when we go back to the manual, and it has a discussion here of what a non-recaptured Section 1231 loss is, hopefully it makes more sense to you now. But the rest of it about how do we report ordinary or capital gain income on the sale of those assets, I haven't even gotten to that yet. So it was kind of putting like the cart before the horse, but we're going to move on now to really looking more closely at these Section 1231 transactions and how they're reported on the tax return. Section 1231 property is comprised of 2 types of property, Section 1245 property and Section 1250. So Section 1231 is on top, and underneath Section 1231 we have Section 1245 and Section 1250. And when we sell assets that are Section 1231 property at a profit or a gain, the gain is treated as capital gains, and it's reported on line 13 and gets capital gain treatment. And to the extent that we have a loss or a recapture of depreciation on Section 1231 property, we are allowed to make that entry on line 14. So we enter losses of Section 1231 property on line 14, and we enter the part of income that comes from the sale of Section 1231 property that is for depreciation on line 14. Let's talk now about Section 1245 property, which is one of the categories that falls underneath Section 1231. Section 1245 property includes any property that is or has been subject to an allowance for depreciation or amortization, and which is one of the following types of property: personal property, either tangible or intangible, and certain other tangible property except buildings and their structural components as described in IRS Publication 544. When you sell Section 1245 property, any gain resulting from the recapture of depreciation is treated as ordinary income. Depreciation and amortization that must be recaptured as ordinary income includes, but is not limited to, the following: ordinary depreciation deductions, as well as any special depreciation allowance and the Section 179 deduction, amortization and other deductions as described in Publication 544, and any basis reduction for the investment credit, qualified electric credit, the alternative fuel vehicle credit, and other credits claimed against the purchase price of an asset, minus any basis increase for credit recapture. So let's look at it again. When you sell Section 1245 property, and we had that in that C exam question, we sold, both of those assets happened to be Section 1245 property. They were property held for use in a business. They had been subjected to depreciation. They were sold at a gain, and part of the gain was capital gain and part of it was ordinary gain. And to the extent that you have ordinary gain, that gain is reported on line 14. Ordinary gain comes from the recapture of depreciation previously claimed, as well as any recovery or recapture of previously claimed Section 1231 gain in the last 5 years. And on line 13, you enter any capital gain that results from the sale of a Section 1245 asset. So 1245 assets are reported on line 13 and line 14, depending on the nature of the gain. And if you are dealing with a loss, the loss is reported always on line 14. Let's compare that to Section 1250 property. Section 1250 property includes all real property subject to an allowance for depreciation that is not and never has been Section 1245 property. Most leasehold of land and buildings are Section 1250 property. The recovery tax rate for depreciation on Section 1250 property is 25%. This rate applies when your taxable income, less capital gains, is more than $36,900 for single or married filing separate, $73,800 for married filing joint or qualifying widow, and $49,400 for head of household. If your income is below these thresholds, then your recovered depreciation is taxed as ordinary income. Thus, if your regular tax bracket is 10 or 15%, then your Section 1250 recovery rate is the same as your ordinary rate. But if your regular tax bracket is 25% or higher, then your Section 1250 recovery rate is 25%. So in other words, the Section 1250 recovery rate is beneficial only for taxpayers who are in really a bracket higher than 25%, 25% and up. The richer you are, the better you benefit from this particular recovery rate. Moving on, we are now looking at the Form 1040, and when we sell Section 1250 property, whether we sell it at a gain or a loss, it is always reported on line 13, and we don't make an entry on line 14 when we sell Section 1250 property. So we're going to come back to this concept of depreciation recapture and figuring profits or losses on Section 1250 and 1245 property in a little bit. But before that, I wanted to interject a little bit of information on non-taxable trades. Now, I do have coming up later in the summer, I think on June 25th, a class where I do talk about like-kind exchanges for a full hour. We do detailed illustrations of how to complete Form 8824 and how to figure the amount of a taxable gain and the amount of deferred gain on a like-kind exchange. But today we're doing a discussion generally on the sale of business assets, and you can dispose of a business asset through a like-kind exchange. And so I wanted to just briefly talk about non-taxable trades and how you would go about identifying if your client has such a trade. In general, the only kind of non-taxable trade is a Section 1031 like-kind exchange, and there are specific rules, a set of 6 tests that must be passed in order for a trade to be a like-kind exchange. Firstly, under test number 1, the property must be business or investment property that you hold for use in your business or investment. It includes things like office equipment, rental property, land, and personal property such as your car or home office does not qualify as Section 1031 property and cannot receive the treatment. There is often the question, well, I sold my house and then I bought another house. Can't I call that a like-kind exchange? And the answer is no, you can't. If you held your old house and lived in your old house for 2 out of 5 years, you may be able to exclude the gain, but you can never say you have a like-kind exchange on the sale of your home because your home is not a business asset. Test number 2, the property cannot be inventory or other items held primarily for sale. Merchandise you hold for sale is not eligible for special treatment under Section 1031. Test number 3, the property cannot be stocks or bonds. Separate special rules apply to the sale of stocks and bonds. And, of course, we talked about those in this morning's class. And the main thing to watch out for on the sale of stocks and bonds is that you need to report each transaction separately on Form 8949, and you need to watch out for those wash sales, among other things. Test number 4, there must be a trade of like property. There must be an exchange of like property as defined by the regulations. And the following properties are considered to be like. Real estate for real estate. The exchange of city property for farm property or unimproved property for improved property is considered to be a like-kind exchange. However, real estate within the United States traded for real estate in a foreign country is not considered to be a like-kind exchange. Depreciable tangible property can be either like kind or like class, and this means property need only be in the same general asset class to qualify for like kind exchange treatment. Examples of like kind property in the same class include office furniture, fixtures, and equipment. A desk traded for a chair would qualify. Information systems such as computers and peripherals are considered to be like kind assets. Calculators and photocopiers are considered to be like kind. Breeding sheep and breeding goats are considered to be like kind, and automobiles and taxis are in the same class and are like kind. But examples of not like kind property include a light general truck weighing under 13,000 pounds is not in the same class as a heavy truck over 13,000 pounds. A breeding horse over the age of 12 is not in the same class as a breeding horse under the age of 12. And assets used to produce sugar products are not in the same class as assets used to grow grain products. You can refer to IRS Publication 946 and Appendix B for a listing of all of the different class types. Test number 5, property to be received must be identified within 45 days after the date you transfer the property you gave up in the trade. And test number 6, the property received must be received by the earlier of 180 days after the date on which you gave up your property or the due date, including extensions for your tax return for the year in which the transfer of property occurs. Now, within the context of like-kind exchange, the most famous type of like-kind exchange that tax professionals and investors commonly talk about is the real estate for real estate like-kind exchange. It's not at all uncommon to have someone who has a piece of real estate that they've been holding for a number of years, and they have a lot of capital gain potential, unrealized capital gain amounts in that property. And if they sell the property outright, they're going to have to pay tax on that gain. And that means they're going to have less money to reinvest somewhere else. So the idea behind the like-kind exchange rules is that you can trade an existing property for another property of like kind, and you won't have to pay tax on the profit that you realize from that sale. It becomes an unrealized profit that is not taxed. Most of the time, like-kind exchanges, when people are talking about them and worried about the intricacies of it, they're thinking about real estate for real estate. And the reason real estate for real estate would be complicated is it's very unlikely that I'm going to be able to take this rental house that I own and find another rental house out there that someone else will trade for my rental house. What are the odds of being able to find that? It's much more likely that I've got a rental house that I'm going to have some person who's not looking to do a like-kind exchange come around and want to buy it. And I'm going to go out and see another rental house that I want to get, and there's not going to be a trade happening. So how do you have a like-kind exchange in a situation like that? Well, you can if you involve an intermediary, and these are companies that essentially agree to buy your old house from you. They go over to the seller of the other house and buy that house from them, and then they trade your house for the house they bought from this other person that you're interested in, and then they sell your first house to someone else. So they're basically third party in the middle perfecting all of these transactions. And they obviously charge a fee for that, but it's usually well worth the money. However, there's usually a lot of headaches and pressures because of these limits and restrictions on the amount of time you have to perfect the trade. Now, less well known, but entirely altogether more common, are like-kind exchanges that occur when you trade in a car. It is probably the case that at least once in your lifetime you've gone to a car dealership with your old car and you've bought a new car from the same dealership. And so you've traded in your old car, gotten the new car, and then you've had to pay cash or borrow money to pay the difference between what they're giving you on the old car and what you're paying for the new car. And if the car that you're trading in was used for business purposes, and the car that you're acquiring is also going to be used for business purposes, now you have a like-kind exchange. And you would report that like-kind exchange on Form 8824 for like-kind exchanges. Next up, we're looking at transfers to spouse. Generally, no gain or loss is recognized on a transfer of property to your spouse. If you receive property from your spouse, your basis and holding period is the same as your spouse's basis and holding periods. Related party transactions. If a gain is recognized on the sale or exchange of property to a related person, the gain may be ordinary income even if the property is a capital asset. A loss on the sale or exchange of property between related persons is not deductible, and if you are selling property to a related person, you should refer to Publication 544 for more information. Sale of property changed to business use, and this comes from IRS Publication 551 this time. If you hold property for personal use and then change it to business use or use it to produce rent, you must figure its basis for depreciation. An example of changing property held from personal use to business use would be renting out your former main home. For depreciation, the basis for depreciation is the lesser of the following amounts: the fair market value of the property on the date of the change, or your adjusted basis on the date of the change. For a sale of property, if you later sell or dispose of property that was changed to business or rental use, the basis of the property you will use depends on whether you are figuring a gain or a loss. For gain, the basis for figuring a gain is your adjusted basis when you sell the property. And for a loss, you're going to figure the basis for a loss starting with the smaller of your adjusted basis, or the fair market value of the property at the time of the change to business or rental use, after accounting for adjustments for depreciation, improvements, etc. This is actually a pretty relevant statement here, because we have just finally, at least in Oregon, started to really pull out of the Great Recession that started essentially in 2008. And real estate was hit super, super hard. Real estate peaked in 2006 and 2007, and then the market just went down, badly down in 2008, and despite efforts by the federal government to introduce tax credits for purchasing first homes, and then later followed up with tax credits for people who own existing homes to purchase more homes, the market just was bad. And there were a number of people who wanted to sell and couldn't, who were forced to start renting their homes. The basis for depreciation for those individuals would be less than their cost basis. So let's just say you bought in 2007 at the peak of the market, you paid $300,000 for a house. And in 2009, the market is completely gone. You can't sell it. You owe more on it than it's worth. You need to move, or you can't afford to live in it anymore. You make a decision to rent it. And at the time you begin renting that house, the fair market value of the house has dropped to $200,000. Well, your basis for depreciation is going to be the lower number of $200,000. Now, let's just suppose you've rented it from 2009 all the way up to where I'm sitting here today, 2015, and you sell that house in 2015 for $350,000. Well, for figuring a gain, which you would have, you're going to use your original cost basis of $300,000. But if you were to actually sell the house in 2015 for only $180,000, then your basis for figuring a loss would be the fair market value on the date you converted it to business use, or $200,000, which would mean if you sold it at a gain, you'd have a $50,000 gain, and if you sold it at a loss for $180,000, you'd have only a $20,000 loss. So this is what this paragraph refers to, and it's pretty tempting as a tax preparer to want to inflate the basis, but I would speculate easily that the IRS would be careful to examine tax returns where a house was placed in service in the middle of the Great Recession but was purchased at the height of the market. I think that they would be evaluating what the fair market value of that house in fact was. So let's move on now to selling a business. Selling a business is a pretty big deal. It involves multiple stages in terms of figuring out what the gain or the loss is on any particular transactions. I have been involved more on the buying end for customers who are getting their businesses started and doing the purchase side of the business. But if you're selling a business, it's all the same information, just reported in a different way for the seller than it is for the buyer. So the sale of a business is not usually the sale of one asset. Instead, all assets of the business are generally sold. And when this occurs, each asset is treated as being sold separately for determining the treatment of gain or loss. So let's just suppose you sell a video game store and it's got 3 locations. Each location has leasehold, it has leasehold improvements, it's got workforce in place, it's got going concern value, it's got goodwill, it's got inventory, it's got physical assets. There would be ownership of a bank account. And unless you're selling stock in a C corporation, all of those individual assets are going to have to be factored together and reported separately for that sale. So a business usually has many assets, and when these assets are sold, they have to be classified as capital assets, real property used in the business, and property held for sale to customers. For capital asset, the sale of a capital asset generally results in a capital gain or loss. For real property used in the business, the sale of real property or depreciable property used in the business and held more than 1 year results in a Section 1231 transaction. And for property held for sale to customers, such as inventory or stock in trade, the sale of inventory results in ordinary income or loss. Now, if you have inventory that you are selling with your business, ultimately that inventory would be reflected as a cost to you through an ending inventory for your business, which would ultimately be zero. So if you're filing Schedule C, and at the beginning of the year you have $50,000 of inventory, during the year you purchase another $50,000 of inventory, and then you sell the inventory along with the business to the buyer. You would not treat the sale of inventory as the sale of a capital asset or of a Section 1231 asset. The sale of the inventory would be reflected as a cost to you by showing an ending inventory on your Schedule C of 0. You must figure the gain or loss on each asset that you do sell separately, and you must prepare and file Form 8594 Asset Acquisition Statement when you sell or buy a business. Both the buyer and the seller involved in the sale of business assets must report the allocation of the sales price among Section 197 intangibles and other business assets. Both the buyer and the seller should attach Form 8594 to their federal tax return for the year in which the sale occurred. Additionally, if you are selling your business or the assets used in your business, you may be required to file one or more of the following forms. Form 4797, Sale of Business Property. Form 8824, Like-Kind Exchange of Section 1031, Business Property. Form 6252, Installment Sale Income, and Schedule D, Capital Gains and Losses. So let's take a look at this 8594. I can't say that it's a form I fill out terribly often, because how often do we deal with complete buys and sells of businesses? But when that does happen, the form is required. It doesn't matter whether you're the buyer or the seller, the form has to be completed. And we can look here at this particular form. It says sample sale. Check the box that identifies you as either purchaser or seller. And we have the name of the other party to the transaction. That would be the purchaser. So the person that you sold to is Joe Buyer, and his address. And then it wants to know what the date of the sale was and the total sales price. Now, once you've got the sales price down, it's time to allocate that sales price of $199,500 between all of the assets that were sold. And IRS says you need to identify the assets as Class 1, 2, 3, 4, 5, 6, or 7 assets. Class 1 assets are cash and general deposit accounts, including savings and checking accounts. Class 2 assets are U.S. government securities and publicly traded stock. Class 3 assets are assets of a type that the taxpayer marks to market at least annually for federal tax purposes. Class 4 assets are stock in trade of the taxpayer, in other words, inventory. Class 5 assets are any assets that are none of the other classes. And that's actually the most common asset category I think you'd run across is Class 5. It includes things like office building, copier, phone system, and computers. And then Class 6 assets are all Section 179 or Section 197 intangibles except goodwill and going concern value. And Class 7 assets are goodwill and going concern value. So this particular form that I filled out, Form 8594, I've used it to actually prepare an illustration for the sale of business assets on Form 4797. So we're going to be keeping this particular transaction for the sale of a business by sample sale to Joe Buyer of these particular classes of assets and how we're going to deal with that. So let's look at the Form 4797, and then we'll go into an illustration of how to complete Form 4797. Section 1231 gains are reported on Form 4797 in Parts 1 and 3. A net gain is carried to Schedule D and is reported as a long-term capital gain on line 13 of Form 1040. A net loss is carried to Part 2 of Form 4797 and is claimed as ordinary loss on Form 1040, line 14. Form 4797 gains and losses use Form 4797 to report gain or loss from a sale, exchange, or involuntary conversion of property used in your trade or business or held for production of rents or royalties. Form 4797 is comprised of 4 parts, and in Part 1, we report the sale, exchange, or condemnation of Section 1231 property held for more than a year and for which recapture or recovery of depreciation is not required. Examples of assets or sales that are disposed of and should be reported in Part 1 include the sale of office equipment used in a trade or business and held long term. Depreciation is not being recaptured because the asset is disposed of for an amount equal to or less than its adjusted basis. Or the sale of real estate used in a trade or business and held long term. Depreciation is not being recovered because the asset is disposed of for an amount equal to or less than its adjusted basis. And finally, the sale of land. Land is not depreciable, and IRS instructions for Form 4797 say to always report the sale of land held for income production in Part 1 of Form 4797. Let's look now to Part 2 of Form 4797. Use Part 2 to report ordinary income from the sale of business assets not reportable in Parts 1 or 3. Asset dispositions reported in Part 2 are generally assets that have been held short term. However, Section 1244 losses are reported in Part 2 even if they are held long term. And examples of asset sales or dispositions to be reported in Part 2 include the sale of office equipment used in a trade or business and held short term, the sale of real estate used in a trade or business and held short term, ordinary gains from the sale of publicly traded partnership units. Well, that's weird. That one just leaped out. What does that got to do with a business? Well, I've actually included a whole section in today's class on that, so we'll figure out why. And finally, Section 1244 losses from the sale of small business stock to be treated as a small business corporation. The total amount of money and other property received by the corporation for its stock as a contribution to capital and paid in surplus generally may not exceed $1 million. And if that is the case, up to $50,000 or $100,000 if you are filing a joint return of loss can be claimed on Form 4797, and any remaining loss is then claimed on Schedule D and subject to the $3,000 a year annual limit. So what that particular rule is saying is that if you are an original investor in a small corporation that had startup capital of $1 million or less and you lost your shirt, instead of being restricted to claiming a loss of only $3,000 a year on your Schedule D, you can instead choose to treat the loss as a Section 1244 loss and enter the loss in Part 2 of Form 4797. You would be allowed to claim up to $50,000 loss if you are single or married filing separate, or you would be able to claim up to $100,000 of loss on a married filing joint return, and it would be offset against other ordinary income and help avoid some of the sting of having lost your shirt on that small startup corporation. Form 4797 Part 3. Use Part 3 to calculate the recapture and recovery of depreciation or amortization on assets used in a trade or business and held long term. Gain on the disposition of an asset that is a recapture of depreciation is taxed as ordinary income, and gain on the sale that is a result of increased value or appreciation is taxed as capital gain. Part 3 is a very important part of the form. If you don't enter assets in Part 3 that are required to be entered in Part 3, then you are going to figure your capital gain amount incorrectly. So the starting point for 4797 is always to do Part 3 first. You need to look at the assets that you're selling and determine what assets belong in Part 3, what assets belong in Part 1. You would figure your gains from the sale of assets in Part 3, and once you finish figuring out Part 3, you carry numbers over to page 1 and begin completing Part 1 and Part 2 of the form. Examples of asset sales or dispositions that you would include in Part 3 include the sale of a car used in a trade or business where the sales price is greater than the adjusted basis of the vehicle and depreciation has previously been claimed for the vehicle. The sale of a franchise for a profit where amortization has been claimed against the original purchase price, and the sale of real estate for a profit where depreciation has previously been claimed. Form 4797, Part 4. There's actually a fourth part. It's way at the bottom of page 2. It's just a tiny little section. And you use Part 4 to recapture depreciation on property for which a Section 179 deduction has previously been claimed and the percentage business use has dropped to 50% or less. Listed property where accelerated depreciation was previously claimed and business use percentage has dropped to 50% less. So either you claimed a Section 179 deduction and then business use dropped to 50% or less, or you claimed accelerated depreciation on listed property and then business use dropped to 50% or less. In either of those two situations, you're going to be forced to do a recapture, and the recapture is figured in Part 4 of the form. Now, income from Parts 1, 2, and 3 of Form 4797 is carried to 1040 line 13 if it is capital gain income, or line 14 if it is ordinary income. However, recaptured depreciation from Part 4 of the form is carried to the form where the depreciation deduction was originally claimed. And here's an example of what I mean. In 2013, Max purchased and placed a computer and service in his business at a cost of $2,000. He claimed a Section 179 deduction for the full purchase price on his 2013 Schedule C. Then in 2014, Max's business use of the computer dropped from 100% to 40%. Calculate Max's recovery amounts as follows. Depreciation that he claimed in 2013 was $2,000, and $2,000 depreciation calculated straight line would have only been $200. The difference between those two numbers is $1,800, and he is going to need to recapture the $1,800 depreciation excess as income on Schedule C. He would enter it as other income on the form, and the recapture would be subject to self-employment tax. So here we are looking at Part 4 of the form for this illustration. You can see we're showing on line 33 in column A the Section 179 deduction claimed. On line 34, we're showing what the straight line depreciation would have been. And on line 35, we're showing the recapture amount. So we are due to begin a detailed illustration of 4797 all filled out. And I'm thinking that if we're going to take a break, we may as well do it now, and then we come back, we'll do these illustrations together. But while we're on break, study this a little bit, because what it's talking about, or what this illustration is going to be looking at, is this particular sale of assets. And these refer back to that sale of the business to Joe Buyer. And so I've got a cutout here of that 8594 where you can see the asset classification. And I just wanted to show you the breakdown of the numbers that we put in each of those asset classes. We have an office building, a computer, a copier, a telephone system. And we enter those assets as Class 5 assets. And then we have the goodwill, which is an intangible, and it gets entered down here as a Class 6 and 7 asset. Now go ahead and study this schedule. It's showing you the asset that was sold, the date bought, the date sold, the cost, land value as a portion of the cost, accumulated depreciation, adjusted basis, sales price, net gain or loss, recapture amount at ordinary rate for depreciation, the recovery rate for 25% depreciation on real estate, and finally the portion of any gain that is capital gain or loss. So what I'd like you to do is be thinking about this particular illustration, and if you were to fill out Form 4797, what part of Form 4797 would you enter each of these assets in? And when I come back from the break, we're going to look at an illustration where some of the assets are in the wrong place and what that means for the accuracy of the tax return. So it's now 2:51. I'll put up the first password for the afternoon class. Password number 1 is Moose, M-O-O-S-E. And yesterday on my Facebook page, my cousin up in Canada put a video on of a mother moose on the front lawn of someone's house. And she had 2 baby moose, calves they'd be called. So there's a cow moose and her calves. And the babies were playing in the sprinkler on this front lawn, jumping and running and licking it, playing in it just like human children would. It was adorable. So we're going to convene at 2 minutes past the hour and pick up with a discussion of the sale of these business assets. Password number 1 is Denali, D-E-N-A-L-I. Denali. Welcome back from break. We are now going to take a look at how to complete Form 4797 for this particular illustration. And in fact, I'm going to do 4797 for you twice. I'm going to do it incorrectly, and then I'm going to do it correctly so that you can see the difference in how tax is calculated when you figure the form correctly versus incorrectly. But to start the exercise, I wanted you to think a little bit, based on the earlier part of today's lecture, how do we even know what goes on what part of Form 4797? Well, let's start with the office building. Remember the rules for Part 3 of Form 4797 are, it goes in Part 3 if it's sold for a profit and there is a recovery or a recapture of depreciation that is a part of that profit. So did we sell the office building for a profit? The answer is we had a cost of $120 and a sales price of $150. It was definitely sold for profit. Did we claim depreciation in the past? Yes, we did. That tells me that the office building belongs in Part 3. Next one, computer. We paid $4,000 for it. We sold it for $500, and ultimately we had accumulated depreciation of $3,078 and adjusted basis of $922. We've actually sold it at a loss. Since the computer has been sold at a loss, it doesn't belong in Part 3. It's going to go to Part 1. Copier. We bought for $8,000. We sold for $2,000. We have accumulated depreciation of $61.57 and an adjusted basis of $18.43. We've sold it for more than the adjusted basis. It means we have a profit. The profit is at least in part due to recapture of depreciation. It's going to go in Part 3. Telephone system. We bought it for $10,000. We have $6,252 of accumulated depreciation, an adjusted basis of $37.48, and we sell it for $7,000. Definitely a profit there and definitely a recapture of depreciation going on, so it goes in Part 3. And then we have goodwill. We paid $18,000 for the business when we started it, and we've sold it for $40,000. Definitely a big profit on the sale, but we also have amortization that was previously claimed, and so that tells me the combination of selling for a profit and having prior amortization tells me it belongs in Part 3. The only other one to take a look at a little bit more closely is this office building. You can see that we have land value in the building, and it depends on the depreciation schedule you're looking at and how you enter things into your software. If your software has an ability to treat the land value as a separate line item, the way it asks for information on the real estate is you enter the cost of the property and then you pull out the land value. It could be that it's going to run it all off on a single line like this. Or it could be that you need to manually think about what the land value is and start a new line on the depreciation schedule. Well, with our software, Drake software, if I pull the land value out as a non-depreciable asset, I can make an entry for it on the depreciation schedule. And when I do that, I'm actually going to have to toggle the sale of the land as being a separate sale from the sale of the building itself. But regardless of how I've set it up in my depreciation system in my tax software, IRS says that the sale of land belongs in Part 1. So to be in strict compliance with the IRS instructions, I'm going to put the sale of the land in Part 1. But theoretically, or in theory, if I leave the land as a part of the sale of the office building, it's going to make no difference to the tax. It's just a pure technicality on where we put the land. But in the first illustration, I'm going to have the land included in Part 3, and then in the second illustration, I'm going to put it in Part 1 because that's where the IRS instructions say it belongs. So I promised that we would look at an illustration where we have done 4797 incorrectly. And now that we've studied where these assets belong, we're going to show you what happens when we put them where they don't belong. When you're completing 4797, it is one of those forms that you're best off starting to prepare it from page 2. And so the first page that I've prepared for you in both illustrations is page 2. And in this first illustration, I've got the office building, the copier, and the telephone system. And I've got the office building plus the land all in one line. I've got the copier and the telephone system. And one of the assets that technically belongs here is missing, and that's the goodwill. Left the goodwill off. But let's see what happens when I just use Part 3 to report these particular assets being sold. You can see that in column A, we have information relating to the office building. In column B, we have information relating to the copier, and in column C, we put information relating to the telephone system. We enter the cost basis of each asset, and we enter the sales price of each asset. And then on line 22, we show the depreciation allowed or allowable on each asset. And we can see that there's $8,760 of prior depreciation on the building, $6,157 on the copier, and $6,252 on the telephone system. We then figure what the total gain is because we're going to use these depreciation numbers to reduce basis, and that gives us a total gain on line 24 of $38,760 for the commercial building, $157 for the copier, and $3,252 for the telephone system. Now it says on line 25, if the asset sold was Section 1245 property, enter the lesser of the gain or the depreciation allowed. And in both cases, the lesser number is the gain, 157 and 3252. So the next step is to add those numbers. 157 plus 3252 is 3409, and that number actually carries down and gets entered on line 31. Then we are instructed to look at the amount of depreciation that is from the sale of 1250 property. You note here that there is a line 26 which you might gravitate towards and say, oh, I need to put a number here because isn't the real estate 1250 property? The answer is yes, it is, but it's property that was not acquired in this time frame of 1975, 1969. It was acquired much more recently than that, and these sections down here only belong to assets that are in unique categories that we're typically not going to be dealing with. Most small business owners are going to be dealing with only this upper part, line 19 and line 25 of the form. And that is the case here. So the other number we're interested in is this $8,760. Then we go down to the bottom of the form and we figure out what our total profit is. We've got $38,760 plus $157 plus $3252. We take all of those numbers, add them up, and we've got $42,169. That's the total gain for all properties listed on Part 3 of the form. And of that gain, $3,409 is ordinary gain from the recapture of depreciation, and $38,760 is going to be capital gain property. And you'll see that the recovery of depreciation on the sale of real estate is considered to be capital gain income. So now that we've gone through Part 3 of the form, let's move over to Part 1 of the form. And on Part 1 of the form, you can see that the computer is correctly listed there, but the goodwill is incorrectly listed there. And what is the consequence of that? Well, the consequence of it is that you can see the depreciation allowed or allowable reduces the basis in the property and increases the gain, but it doesn't allow you anywhere to break out the gain as being ordinary or capital, and it ultimately treats all of it as capital gain. So we have a loss on the sale of the computer. We have a gain on the sale of the goodwill. We take those numbers and add them to the amounts figured in Part 3 and total them up. And ultimately we have $64,538 that is entered as capital gains on line 13 of the 1040, and we have $3,409 that is entered as ordinary income on line 14 of the 1040. Okay, well, so what with that? Well, the difference actually starts when we get to the unrecaptured Section 1250 gain worksheet and then move on to the capital gain worksheet from there. So on the Section 1250 gain worksheet, what this worksheet asks you to do is to enter the amount of depreciation that is recovered or unrecaptured gain on the sale of Section 1250 property. And that is, of course, the commercial building. $8,760 of depreciation was claimed on that. The reason we care about that number is that we need to complete Schedule D. And in Part 3 of Schedule D, we need to enter that amount on line 19 of the schedule. And then we're going to take the portion of the gain from the sale of those capital assets that is capital gain and separate out the portion of that capital gain that is unrecaptured depreciation. Now we go over to the Schedule D worksheet, and the starting point on the Schedule D worksheet is to enter the taxable income for our filer, and this filer has $93,678 of taxable income. I'm just going to throw that at you so you have a number to start with. And then we say, okay, of that income, how much is capital gain income from the Schedule D? Well, $64,538 is the capital gain income. So line 16 of the Schedule D is being carried down and entered here on line 7. Then the form asks what portion of that capital gain is for that unrecaptured Section 1250 gain, and that's $8,760. We pull it out. So ultimately what we have is $55,778 of capital gain that's going to be taxed at a maximum rate of 15%, and we're going to have $8,760 of gain that will be taxed at a maximum rate of 25%. Now we need to determine what tax bracket this sample sale falls into, and we've made him a single filer. And so is his income without regard to capital gain more than $36,900? Yes, it is. After we subtract out all of his gains from his other income, we're still left with a number that is more than the threshold amount for his filing status. So it means that he's going to be taxed at a rate of 15%, and it also means he's going to be exposed to a 25% tax rate on some of his income as well. We move down to line 28 and 29, and on line 28 we enter the total amount of capital gain income reported from the 1040, excluding the amount that is Section 1250 gain, and then we multiply that gain by 15% to get $8,367. We then move down to figure out how much of the unrecaptured Section 1250 gain is going to be taxed at the 25% rate. And the interesting thing about the way this worksheet works is that to the extent the recovery or unrecaptured Section 1250 gain falls for a person in the 15 or 10% brackets, it is treated as ordinary income. So we're determining how much of the unrecaptured Section 1250 gain is included in ordinary income. And when we're done, we determine that $7,760 of it is includable in ordinary income, leaving only $1,000 that is going to be taxed at the 25% rate. And so we're then going to take that $1,000, multiply it by 25%, and we get $250. Then on line 42, we figure the amount of ordinary tax owed on $36,900 of income. When we do that, we get $5,088. And then on line 43, we enter $13,705, and this is the total amount from lines 29, which is the capital gain amount, 38, which is the Section 1250 tax, and line 42, which is the tax on the ordinary income. You add all of those amounts up, and you get $13,705. And then the next step is to go to the tax tables and look up the tax on all of the income for the year, $93,678. When you do that, you get a much higher number, $19,405. And this filer can claim the lower of the two taxes, the amount on line 43 or the line on 44, and it's a no-brainer. They're going to go for the lower number of $13,705. So let's go over now and think about how that is going to be affecting the 1040 return. I'm telling you right now that this tax that we've got on line 45 is too low, and the reason it's too low is that we have not done a recapture of amortization claimed on the goodwill. Although the land is also technically in the wrong part of the form, it makes no difference to the computations. Let's see how things change when we switch things around a little. So we're now on to illustration number 2, and in illustration number 2, we're putting all of the assets where they belong, and in fact, when it comes to that office building, I actually broke out the sales price and the acquisition cost and did an allocation of the sales price and the cost basis between land and structure to break that out. And then the copier and the telephone system and the goodwill are all listed on here as well. And now we've got numbers in all 4 columns going all the way across. The total gain for all of these assets is $63,369. And if we look at how much of the gain on these assets is for recaptured Section 1245 gain, our number has increased substantially and is now $7,609. So $7,609 is switching around the makeup of the amount of gain that is going to be taxed as ordinary income. And when we look at the front page of the 1040, we now see that we're going to have $7,609 entered on line 14 instead of $3,409 that we had in the first illustration. So in the first illustration, line 13 is $64,538 and line 14 is $3,409. And in the second illustration, we've got $60,338 on line 13 and $7,609 on line 14. Well, how and why does that matter? Well, going over to page 1 of the 4797, we've now got the land and the computer where they belong. And, of course, we're dealing with much smaller capital gain amount here. And we then carry over the capital gain from page 2. We add that to the gain on page 1, and we get $60,338. That is the amount that, again, is carrying to line 13. And then we move on to the capital gain worksheet. And again, we're starting with the same overall taxable income, but we're entering a smaller amount of gain on line 7. We still have to subtract out the unrecaptured Section 1250 gain to arrive at the total capital gain income for this particular filer. We subtract the capital gain income from the taxable income. We get $42,100. Then we look to see where this filer falls in terms of the threshold amount for their filing status. Their income is above that. It means none of the gain is going to be eligible for that 0% capital gain treatment. It's all going to be taxed at 15%, except for any portion of the gain that is Section 1250 gain, and that can get taxed at a maximum rate of 25%. Well, this time around, due to differences in the capital gain spread up here, the amount of income from the recapture of the Section 1250 gain that's going to be taxed at 25% or higher has just risen. So in the earlier example, we had only $7,760 of Section 1250 income that would be not taxed at the 25% rate. It would be included with ordinary income. But this time around, the number is much smaller, and ultimately we're left with $5,200 instead of $7,760. And so the tax has gone from $250 on line 38 up to $1,300. But we also have more income that's shifted over to ordinary income in general. So when we're all said and done with figuring the amount of tax owed on this individual's 1040 return, we can see that the tax has gone to $14,125, which is more than it was in the earlier illustration. So let's look at a summary of what the total computations for those two illustrations are. In illustration number 1, the recapture amount on Form 4797, line 31, is $3,409, and this is too low. As a result, the amount of income eligible for the lower capital gain rate, $55,778, is too high. Therefore, line 45 of the Schedule D tax worksheet for illustration 1 shows $13,705 of total tax, and that's the wrong number. Whereas in illustration number 2, the recapture amount on Form 4797, line 31, is $7,609, and that is the correct amount. So the amount of income eligible for capital gain treatment drops to $51,578, and the amount of tax shown on the capital gain worksheet increases to $14,125. So in illustration number 1, we came up with tax of $13,705. In illustration number 2, we come up with $14,125. The difference between those two numbers is $420, and because of the simple effect of entering the goodwill on the wrong line or in the wrong part of the form, tax was underestimated by $420. So that concludes that review of completing 4797 correctly and incorrectly. We're now going to look at reporting the sale of vehicles used in a trade or business. If you sold or otherwise disposed of a vehicle that you used in your trade or business, you generally need to report the sale on Form 4797, and this is true regardless of whether you claimed the standard mileage rate or actual expenses. So how do you figure gain when you use the standard mileage rate instead of claiming actual depreciation? Well, if you use your vehicle for business and you claim the standard mileage allowance, any subsequent disposition of the vehicle will result in the disposition of a business asset for which depreciation has been claimed. For 2014, 22 cents of the 56 cents per mile rate is allocable to depreciation. You follow these steps to figure the amount of depreciation you claimed on a vehicle for which you claimed the standard mileage allowance. You determine the number of business miles driven each year, and for each year, multiply the miles by the portion of the standard mileage rate that was for depreciation. So these are the standard mileage rates that were in effect for earlier years, the portion of the standard mileage rate that is for depreciation. For 2015, the portion of the standard mileage rate that is for depreciation is 24 cents a mile. For 2014, it was 22 cents, and then for 2012 through 13, it was 23 cents. 2011, it was 22 cents, and so on. It goes all the way back to 1999 when I first started to track this. And let's look at an illustration of how this would work. In 2002, you purchased a car for business use costing $20,000. You drove the car 10,000 miles for your business in 2012, 5,000 for business in 13, 7,000 business miles in 2014. Then during 2014, you sold the car for $10,000. Total mileage for the car is shown for each year in the following chart. We can see the total miles were 15,000 in 12, 9,000 in 13, and 11,000 in 14 for total business miles of 35,000. And then we show the portion of those miles that was business miles. So we have 22,000 out of 35,000 miles that were business miles. And then we've taken the number of business miles driven each year and entered the standard depreciation amount for each mile driven. And then we convert that into a depreciation amount that was claimed for each year. So we end up on this vehicle showing $4,990 of prior depreciation claimed. Now, the total business use percentage for the vehicle is 22,000 miles divided by 35,000 miles, or 62.86%. So what happens if we sell this car? Well, we sell the car for $10,000 and we bought the car for $20,000. So do we have a gain or loss? And if so, how much? Well, we're going to take the cost basis of 20, multiply that by the business use percentage of 62.86, and get a business use basis of $12,572. We then subtract out the accumulated depreciation that we figured right here of $4,990, and we end up with our adjusted business use basis of the vehicle. Next, we have the sales price, and we also need to multiply that by the business use percentage of 62.86%. When we do that, we get $6,286, and the bottom line is we have a loss on the sale of $1,296. Where would I report this on 4797? It would go on 4797 in Part 1, yes. Okay, so that's it for 4797. I have a classwork assignment that will give you a few minutes to look at if there's time at the end of the day, but before we get to that, I wanted to discuss publicly traded partnerships. They're kind of an, ew, gosh, I don't like PTPs. They're not so bad now that I feel really confident about what I'm doing with them, but early on when I was looking at these PTPs, it's like, gosh, how do you do this? All of these worksheets were coming out from the partnerships with instructions to fill them out and do corrections to basis, and numbers had to carry to 4797, and it was not comfortable not knowing exactly what was supposed to be going on and not having really seen illustrations. I kept looking in the instructions for sale of assets, trying to determine what to do with these publicly traded partnerships, and I just wasn't finding information that I wanted in those instructions. I finally called the IRS Tax Practitioner Hotline, and this was at a point where IRS actually had people that would answer your questions. Of course, 2 years ago, they stopped answering questions, and now no one can answer your questions. But back then, I could get people to answer my questions. And so I'd call the Tax Practitioner Hotline, and I'd say, well, I've got this PTP, and I've sold some of the shares but not the others, and I need to figure out how much loss I'm allowed to take for this year because I've had the sale of shares. And the auditor I was speaking to said, will you do this? And I said, well, yeah, that makes sense. That's what I want to do, but I want to know that it's correct. Where can I find it in writing that that is the instruction? And she said, well, I don't know. Let me get back to you. So she hung up. And it was a day or two later that she called me, and she said, well, this particular rule is in the instructions for the partners K1, and this particular rule is in this place, and this particular rule is in that place. So once I had her tell me where everything was, I was able to compile it into a succinct format, and I'm delivering it here to you today in our class. And why have I put the sale of PTPs into a class on the sale of business assets? Well, ultimately, the sale of a PTP involves preparation and entries on Form 4797. And so that's why I've stuck it in with the sale of business assets. So the purchase and sale of a PTP is a transaction type reported on Form 1099-B, proceeds from broker and barter exchange transactions. However, Section 7704 of the Code provides that except as provided in that section, a PTP is treated as a corporation. A PTP is a partnership whose interests are traded on an established securities market or are readily tradable on a secondary market. Ownership in a PTP takes the form of units, and these units are traded on the stock market in much the same way as corporate stock is traded. If you buy PTP units, you become a limited partner in that PTP. How will you know your client has ownership in a PTP? Well, typically when you're looking through a brokerage statement and you're trying to figure out what lines on that brokerage statement might possibly refer to a PTP, you may not be able to figure it out. However, if they have ownership in a PTP, they should be bringing you K1s for the PTP. And once you see those K1s, now you've got something of interest. Firstly, the K1 needs to be entered in the software. And if there's any income or loss amounts on it, you have to deal with those. And then finally, if you can see that this particular K1 is showing that there were distributions during the year coming out, it's possible that those distributions were because units were sold or disposed of. And now you've got to do something. Now, in recent years, PTPs have started to issue worksheet, and they give you instructions on how to use the worksheet to adjust the basis or to affect how the gain or loss from the sale of PTP units is going to appear on the tax return. Now, if you own units in a PTP, you are a limited partner. You're not an active participant. You're limited, and that means that the nature of any losses you have or any income you have is passive. But unlike regular forms of passive income or passive loss, which can offset each other, if you have passive income or passive loss from PTPs, you can only use those income and loss amounts to offset each other from within the same PTP. You can't have a loss from one PTP offset by loss income for another PTP, for example. So as a limited partner in a PTP, you must report pass-through income and loss amounts on your tax return. Certain pass-through items will affect your cost basis in the PTP units that you own and can result in ordinary income that is reportable on Form 4797. Let's look firstly at the tax-free return of capital reduces basis. One of the things that people like about PTPs is they'll buy units in the PTP, and then the PTP starts giving them money back that they don't have to pay tax on, because the first amount of money paid out of the PTP is usually a return of cost. But of course, if you're getting money back out of the PTP as a return of cost, it ultimately is reducing your basis in the PTP, and it will increase the profit you have. But your original cost basis in that PTP is what's reflected on the 1099-B, and not the reduced basis that is as a result of these amounts being given back to you. PTPs usually treat distributions as tax-deferred return of capital, and a return of capital is not taxable. However, it does reduce the basis in the partnership units. Passive activity loss rules limit allowable losses. If a PTP has a loss for the year, the loss is considered to be a passive activity loss. And passive activity loss limits require the losses to be carried forward each year until the PTP either realizes a taxable profit or the partner disposes of his or her interest in the partnership. Losses from one PTP may not be offset by income from another PTP or from any other income from other passive activities. I should tell you that in the tax software we use, Drake, when we're entering information in on passive activities, whether they are K1s or whether we're looking at rental property, the screens offer a checkbox where we can indicate whether there was a complete and total disposition of the asset during the year. And if we don't check that box, then the software doesn't allow losses for the current year or prior years. So it's important that if you know there was a disposition of assets either in part or in full, that you are aware that you're going to have to tell the computer that there was a disposition, or the computer will continue to disallow these losses. Sale, exchange, or other transfer of partnership interest. A net passive loss from a PTP may not be deducted from other passive income. Instead, a passive loss from a PTP is suspended and carried forward to be applied against passive income from the PTP in later years. If the partner's interest in the PTP is completely disposed of, any unused losses are allowed in full in the year of disposition. And we're going to talk a little bit now about the partner share of income and loss from an electing large partnership. And this particular instruction I'm about to give you comes from IRS Publication 541 on partnerships, page 11, where it says the sale or exchange of a partner's interest in a partnership usually results in a capital gain or loss, but that there are special instructions for PTPs. Section 469 provides that the passive activity limitations must be applied to each item or separately to items from each PTP. Passive activity losses, or PALs as they are called, from a PTP generally may be used only to offset income or gain from passive activities of the same PTP. And this particular instruction comes from page 4 of the partner's instructions for Form 1065 Schedule K1. Do not report passive income gains or losses from a PTP on Form 8582. Instead, use the following rules to figure and report your income gains or losses from passive activities that you held through each PTP that you owned during the year. Combine any current year income gains and losses and any prior year unallowed losses to see if you have an overall loss from the PTP. Include only the same types of income and loss that you would include to figure your net income or loss from a non-PTP passive activity. If you have an overall gain, the net gain portion, or the total gain minus total losses, is non-passive income. On the form or schedule you normally use, report the net gain portion as non-passive income and the remaining income and total losses as passive income and loss, and to the left of the entry space, enter Form PTP. But if you have an overall loss but did not dispose of your entire interest in the PTP to an unrelated person in a fully taxable transaction during the year, then the loss is allowed only to the extent of income, and the excess loss is carried forward to use in future years, if you have income to offset it. Report the portion of the loss equal to the income as a passive loss on the schedule or form that you normally use, and then report the income as passive income on the form or schedule you normally use. Didn't that make brilliant sense? Well, that's the IRS instructions for you. So I'm going to take those instructions along with a couple of illustrations that the IRS has and actually put those on tax forms so you can understand what those words are saying. And here we have the first example, which is for a character named Lucas, and he sold his entire interest in the PTP Oil and Gas Limited Partnership for a gain of $2,000. The PTP had a current year Schedule E loss of $3,330 and a Schedule E prior year unallowed loss of $1,115. So you're going to add those two numbers together to get the total loss that he has from that particular PTP. You're going to report income and loss amounts from the sale of the PTP shares as follows. You enter the net current year loss plus the prior year unallowed loss to get $4,545, and you're going to enter that on Schedule E in Part 2 in Column H as a non-passive loss. And then enter the $2,000 gain on the sale on Form 8949 in either Part 1 or Part 2, depending on how long Lucas held the partnership. So let's look at what this is saying. We have an oil and gas limited partnership, and the passive loss or the non-passive loss, whichever it's supposed to be, is going to be allowed on this particular PTP because there was a complete disposition of all of the units. And so these losses, where are they coming from? They're not capital losses. They're not reflected anywhere on the Schedule D. They're not reflected anywhere on the 1099-B that is issued when the stock is sold. Rather, these are operating losses of the partnership that were previously not allowed to the individual owner of units because the individual owner is not an active participant in the partnership. So we end up on line 31 with being allowed to claim these losses of $4,445, and they're going to carry over to line 17. Now, if we have a capital gain on the sale of these units, that capital gain is still going to get entered on line 13 as income. So this is a situation where the allowed loss from the operating losses of the partnership are going to be allowed in full, even though they're less than the income from the partnership for the year. And the reason this is the case is because we have a complete disposition of the units. Let's compare that to example number 2. In example number 2, which is based on an example provided on page 4 of the partner's instructions for 1065 K1, Alice received a Form 1065 Schedule K1 from the PTP Hanford Limited Partnership. Alice's share of current year and prior year losses is $12,000. The K1 shows Alice's share of the gain to be reported on Form 4797 gain is $7,200. Report $7,200 of gain on the appropriate line of Form 4797, and then on Schedule E, report $7,200 of loss as a passive loss, and then carry this amount to Form 1040, line 17. Carry forward to 2015 the unallowed loss of $4,800. So we're going to move on now to the Schedule E, page 2. And on Schedule E, page 2, we show that we have a loss from a publicly traded partnership of $7,200. And that loss is less than the total losses we have, but it is equal to the income. Up here in the wording, we say we have $7,200 of income for the year. Alice's share of the prior year losses is $12,000, but she has a gain to be reported on 4797 of $7,200. She is allowed to claim up to $7,200 of these losses in the year because she's reporting $7,200 of income. So we go over to page 2 of Schedule E, and we then report the allowed loss equal to the income. The income is reported on line 14 as ordinary income, and the allowed loss is equal to that income. Now, if she had completely disposed of all of the units, she would be allowed to enter $12,000 loss on line 17, but she didn't dispose of all of the units, so her loss cannot be more than the income reported from that specific PTP for the year. Unallowed losses from the PTP must be prorated if you have unallowed losses from more than one activity of the PTP or from the same activity of the PTP that must be reported on different forms. You must allocate the unallowed losses on a pro rata basis to figure the amount allowed from each activity or on each form. Now, I've created a detailed illustration for you, and it's based upon examinations I've had of tax documents brought to me by clients. I've taken real documents and then converted those into a problem for you. And these documents that you see in the problem are pretty much exactly what it is I see my clients bringing into me currently. Our character in this story is Magic Debut, and he sold units in the PTP called NSH Transfer Partners LP. He has prior unallowed losses from NSH of $6,044, and he received the following K1 and other year-end information from the PTP as shown next. Also, NSH Transfer Partners provided Magic with the following transaction schedule that we see right here, along with a sales worksheet and instructions for figuring his gain. So what does this tell us? Well, it shows us that he bought units, or that he started the year owning units, and he had 2,700 units at the opening of the year. And then during the year, he sold 2,550 units, so at the end of the year, he owned 150 units. So that's what this particular transaction report is telling us. We then move over, and he received a K1. So if your client's coming in with a K1 like this, and it says something partners, LP, and it says limited partner here, odds are that this is a publicly traded partnership. It could be that they're owners in a different type of partnership, but odds are that this is a publicly traded partnership. So you want to be looking for that, especially when you see these ownership percentages that are fractions of percentages. So this particular K1 is showing that there is an ordinary business loss of $5,502. Because this is a PTP and it is a passive activity, that loss is not allowed unless there is income from the partnership. We also do have income. We have $36, $39 of dividend and interest income. We also have an extra $2 of income down here. But look at this. On box 19, we have a distribution amount of $9,028. Then when we go over and look at the Schedule L here, or line L, we see that we have information on the partner's capital account. He started the year with $86,103. There was a decrease in the account of $6,113. There were withdrawals and distributions of $85,009, and he actually ended up with the year with a negative account balance. That's interesting. So where did this number 6113 come from? Well, actually, you can analyze the Schedule K1 and see where that total comes from. You start with the loss up here, and then you add in the income amounts, 36 plus 39 plus 2. And when you add those up, you get $77. We then look at this tax-exempt income or non-deductible expenses, and in this case, it's non-deductible expenses that totaled $688. So you have negative 5502 plus 72 minus 6888, and when you do that, you get $6,113 negative, and that's where that number came from. So bottom line is we have this loss up here. We also have income. What are we going to be able to do with Magic Debut's tax return? The other piece of information that this K1 came with was the sales worksheet. So NSH Transfer Partners issued the sales worksheet to Magic Debut, and Magic Debut is bringing me this worksheet. It's kind of just buried in an envelope full of other information from the partnership. You got the K1 on top, and then you got all these extra information things, and one of these sheets of paper that's in there looks just like this one. And this is of interest because I know that Magic sold some of his units or most of his units during the year, and this worksheet is going to be used to help me determine what his gain is from the sale and what part of the gain is going to be reported on Form 4797 in Part 2 and what part of the gain is going to be reported on Schedule D. And it also has transactions that would be entered as alternative minimum tax adjustments on Form 6251. The partnership has done me the favor of listing the units that were sold, showing me the date of acquisition, the sales date. It hasn't filled in the sales proceeds or the original purchase price. They don't really know that. Magic's broker knows that. But they do know, based on Magic's ownership of the partnership units, how much adjustment to basis he has and how much, as a result of these adjustments to basis, is going to be determined to be ordinary gain to Magic. So let's go look now at the 1099-B. Magic received this 1099-B right here in the substitute format. It's showing the sales of the units, 200, 300, 200, 1,500, and 350. And you know what? Those are not really a match to the sales amounts shown on the sales worksheet. And the reason is that these sales of 100, 200, 200, and 1,000 shares have all been lumped together on the 1099-B. Yeah, this happens. I base this on a real situation where I'm having to decipher this stuff all the time. So it's not enough to have to fill out the worksheet for the sales that are on here. I now have to break up one of these sales into multiple numbers to then fill out the worksheet correctly. So I've done that, and I've allocated how much of the purchase price of these shares is going to be and how much the sales price of each of these shares is going to be. And ultimately, I took $75,000 and divided that by 1,500, and when I did that, I got $50 per unit sales price, and I took $63,000 and divided that by 1,500 to come up with $42 per unit purchase price. I then use that information to go down to the worksheet to figure out what portion of the proceeds are due to each transaction listed. So the first one shows 200 units. I'm going to find the corresponding transaction, which is right here, and I'm going to pull the proceeds less commission of $10,400 and stick it down on the worksheet. The next stage is to go up and find the cost basis of $6,000, put it on the worksheet. Those are the numbers I manually enter, and I do it for each and every transaction. Then we see that there's an adjustment. Well, this adjustment is a reduction to basis. So whatever amount I have entered for basis, I'm going to subtract this number out of the basis, and then I'm going to take that total amount and subtract it from the sales proceeds. And when I do that, I get the total gain or loss all across the board. So the total gain that I'm showing here is $62,876, which is much higher than the gain showing on the 1099-B. Of course, we have incorrect basis reporting all over this 1099-B, and the only way I know that is because I filled out the sales worksheet to figure that out. Now the worksheet is telling me that of the $62,876 of gain, $25,168 is ordinary gain that needs to be reported as income in Part 2 of Form 4797. And the remaining capital gain, $37,708, is going to be carried to Form 1040 after I complete Schedule D. So now it's time to do the Schedule D. And prior to preparing the Schedule D, I actually did this worksheet here. And I used this worksheet to figure out the amounts that I'm actually going to carry over to the Schedule D. And you can see these are the amounts showing on the 1099-B. And because they were reported on a 1099-B and they were long-term, I'm filling out Form 8949 Part 2, and I'm checking box D, long-term transactions for which basis was reported. And I know that the sales proceeds and the basis amounts that are reported on 8949 must be an exact match to the 1099-B statement. Then I have to determine, after I've done these allocations to Form 4797 and adjustments for basis, what my basis adjustment is going to be that I'm going to enter in column G. And I figured that here with these numbers, so that these are the adjustments necessary to be entered in column G all the way down. And although I'm showing negative numbers here, they actually turn into positive numbers here because the point of them is to increase the profit. Ultimately, the capital gain showing on Schedule D is $37,708, and that is greater than the gain or loss reported on the 1099-B. So the next step is, of course, to carry those totals over to Schedule D, which you can see I've done here. And then it's time to move on to Form 4797. Form 4797, in Part 2, we're going to list the income that we figured on the worksheet that is going to be taxed as ordinary income. And here, because we have more transactions than will fit on line 10, we've entered a description of from K1, the date acquired, the date sold, the price. All the way down is simply the amount that is going to be ordinary income. We arrive at a total ordinary income amount of $25,168. There's also this rule that says when you do a reporting in this way that you're supposed to attach a statement. It's a Section 751 statement, which reads, the taxpayer has reported ordinary income upon the disposition of units in MSH Transfer Partners LP as provided by the general partner. The amount was determined in accordance with the Internal Revenue Code Section 751, and detailed information is available in the Office of the General Partner upon request. We're now going to complete Magic's Schedule E, page 2, because we've just determined that he has a whole bunch of income from the sale of PTP units. That means those losses he's been walking around with, he's going to be allowed to claim them. Now, he has a carryover loss of $6,044 and a current year loss of $5,502, and these are going to be allowed to the extent he has income from the sale of his units. His ordinary income reported on 4797 is $25,168. That is way more than the losses. So the losses, which total $11,546, are going to be allowed in full. And then on line 41, we complete out the amount that is going to be allowed, and this will, of course, carry to Form 1040 and get plunked right down here on line 17. So in summary, he's showing interest income from the K1. He's showing dividend income from the K1. On line 13, he is showing his capital gains from the sale of the units. And on line 14, he's showing the ordinary income from the sale of the units. And finally, he's allowed an offset on line 17 for all of the disallowed losses from the current and earlier years. Now, I wanted to show you one more item, and this is a K1 that has been issued by a PTP to an IRA. And this is kind of one of those rookie things that I see come across my desk every once in a while. My clients will come to me and they'll show me these K1s. In fact, this tax season I had a rather humorous situation. I had a man walk into my office, and it was early April. It was a weekend. This man had been sitting at his kitchen table torturing himself with TurboTax all weekend long, trying to figure out what to do with a K1 that looks exactly like this one. And he said, would it be all right if I pay you for some tax advice or help me out with something? And I said, well, you know, I'm happy to help you out. Let's just see what your problem is. So he sat down with me at my desk, and he handed me this K1. And my eye went straight to the fact that it was an IRA K1. And I said to him, you don't need to report this anywhere on your tax return because this is not income that was paid to you or relevant to you at all. This is a K1 that has been issued to your IRA, and any income or losses going on internally within your IRA are not reportable. And that's exactly what it is. I've had people on my staff over the years come to me with these documents confused, and of course this man walking into my office all pathetic near the end of this year's filing season was just another example of it. So the message is that these K1s, if they are issued by a PTP, are absolutely relevant to your tax client unless they're inside that client's IRA. And if they're inside the IRA, you can go, phew, I don't have to deal with it. So that concludes today's lecture on the sale of business property. Let's take a look quickly at the classwork assignment that I prepared for you today. It's a brand new assignment. You only have to do one thing, fill out Form 4797. So it's about as easy as I give you for a course like this. Donna Troy owns the clothing manufacturing business, Golden Lasso, LLC. And business income and expenses for this business are reported on Schedule C. During the year, Donna's business disposed of the following assets, and we're showing you what those assets were, her cost in the assets, the holding period of the assets. Note here that she has a commercial building that cost $150,000, and of that $150,000, $50,000 is for land. We also show the accumulated depreciation, and your job is to take the sales price and use all of this information to prepare a Form 4797 for Donna. So let me pull up the answer key for this. And if you care to read the verbiage of the answer key, how we're arriving at our mathematical computations, we've got descriptions of how we've made our entries in the earlier part of the key. But let's just move over to the 4797 and look at what we've got entered here. Okay, so we can look at the 4797 and the original problem at the same time. And we can see that on the original problem we have a screening machine, a commercial building, a sewing machine, and a cutting machine. And we need to go through these particular assets and determine which assets were sold at a gain, which assets were sold at a loss, if any, and if they were sold at a gain, is any part of the gain due to a recapture of depreciation. Well, the rule with Form 4797 is you start with page 2 first. So on page 2, we identify the assets for which income is being reported, and any part of that income is a recapture of depreciation. And we can see that the assets that fit that bill are the commercial building and the sewing machine. But the cutting machine, Donna paid $10,000 for it. It had $4,000 of depreciation, so that means it has an adjusted basis of $6,000, but it sold for $5,000. That's a loss. So it's not going to go in Part 3. We then have the screening machine, which cost $20,000, had accumulated depreciation of $8,000, giving us an adjusted basis of $12,000, and then it sells for $12,000. So it was not sold at a gain. It was sold for exactly a wash. And then we have two other assets that were sold at a gain. That is the commercial building, which cost $150,000 and sold for $300,000, and also had $25,641 of depreciation. So that's definitely sold at a profit, and part of that profit is because of prior depreciation. And then the sewing machine was purchased for $8,000. It had accumulated depreciation of $8,000 and then sold for $2,000. So we have a profit entirely due to recapture of depreciation. So those are the two assets that are going to go on Part 3 of the form. We begin on Part 3 by entering each asset and the date acquired and the date sold. And then on the commercial building, we've subtracted out the land. So if the land is 1/3 of the purchase price, it's going to be 1/3 of the sales price. That seems reasonable. So after subtracting the land out, we have a purchase price of $100,000 for the building and a sales price of $200,000 that we're going to allocate to the building. We allocate $25,641 of prior depreciation to the building, and that gives us an adjusted basis of $74,359 and a gain on the sale of the building of $125,641. For the sewing machine, we show that the gross sales price is $2,000, that the cost was $8,000, the depreciation previously claimed is $8,000, and the gain is $2,000. How much of the gain is Section 1245 gain? $2,000 is Section 1245 gain, and the remaining $125,641 is going to be capital gain. So we carry those amounts down. On line 30, we enter the total amount of gain, $127,641, and then on line 31, we pull out the amount that is ordinary gain from the amount that is capital gain, and capital gain is the amount left on line 32, and we're going to remember both those numbers and go back to page 1. We're going to enter the $2,000 on line 13, and we're going to enter the $125,641 on line 6. Then on part 1 of the form, we enter the other assets sold, the screening machine, the land, and the cutting machine. And of course, the land had a cost of $50,000 and a sales price of $100,000 for a capital gain of $50,000. The screening machine sold at a dead wash, so we enter 0 as the gain on it, and the cutting machine ultimately sold for a $1,000 loss. So we're going to add 50 minus 1,000 to the 125,641, and that gives us total capital gain income for Donna Troy in the amount of 174,641, and total ordinary income in the amount of $2,000. So that concludes today's class on sale of business property. Hopefully it all made sense to you and you're ready to tackle these items again in the future. For those of you who wanted to know more about my Diana Prince problem and the challenges it presents, that is under the homework assignment. And you can see it's a complex assignment where we're asking you to do 1040, Schedule A, Schedule D, Schedule E, 4797, the capital gain worksheet, the unrecaptured Section 1250 gain worksheet. Have fun with Diana. She sold a rental property. That's all she did, is sold a rental property. So if you have a client that sold a rental property, this problem is for you. And let me give you the final password of the day, and we can call it done. Password number 2 is Dolphin, D-O-L-P-H-I-N. Dolphin. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.